Okay, it appears that we are live streaming to YouTube.
Thank you, Star. We'll go ahead and call to order the Genesee County Employees Retirement System meeting. Madam Clerk, would you please take roll?
Carpenter. Seifert.
Here.
And then
Make sure
location.
yeah.
Oh, yeah. Seifert's from Genesee County.
Okay. Golden. Khan.
Present, Genesee County.
Mandelaris.
Present, Flint Township, Genesee County, Michigan.
Pepin.
He's excused.
Russell.
He will be late.
Simpson.
Present, Genesee County, Michigan.
And Young.
Present, Flint and Genesee County, Michigan.
And Golden just jumped on.
And Carpenter's here, Genesee County, Michigan.
Where's
And
Gold?
Amy, where would you be from?
Flint Township.
Thank you.
Got it.
Right, we do have a quorum present. So at this time, the board has time set aside for public address to the board. Jennifer, did you receive any emails, messages, any communications requesting public address to this board?
I did not.
Okay, is there anybody online that would like to address this body under public address? Going twice? Going 3 times? Public address is now closed. Moving on to communication items, we do have a report from Jeff Seifert in regards to Cornerstone. Jeff, I'll go ahead and let you bring us up to date.
Yeah, thank you. I sit on Cornerstone's advisory board for the real estate fund number 10. That's where we have our monies invested through them in various real estate ventures. Last week, I had a Zoom meeting with them. I believe it was Tuesday afternoon. The report I can give you is that it's the fourth quarter, 2020. Currently, there are 4 properties left in Fund 10, and they are, just one second, there is a plaza in Orange County, California of office space. It's 212,000 square feet, 81% leased. Crossroads Town Center in Las Vegas, it's retail, 148,000 square feet, 78% leased. Motion at Dayline, it's in Miami, it's apartment complex, 294 units, and it's 86% leased. Franklin Distribution Center, it's in Boston, it's an industrial building, 300,000 square feet, it's 100% leased. Expectations going, past performance, they're indicating about a little over 8%. Going forward, it's between 5 and 8%. That's about it. Any questions of me about Cornerstone, which is Bearings, and I'd be happy to try to address them.
Anybody?
I have a hard copy that my goal is to eventually drop it off at Jennifer's office when I'm in Flint at some point. So from that, she can make copies and probably distribute them to everybody else. Thank you.
Thank you, Jeff. All right, moving on. Next item of business we have is approval of the minutes from the February 4th meeting. Would you like to do all of these minutes at one motion, or
No,
would you like to do them separately?
separately.
Okay, we have the investment committee meeting minutes of February 4th. What's your pleasure?
This is Seifert. I'll move to approve the minutes.
Carpenter support.
Been moved, it's been supported. Is there any discussion? Seeing none. All those in favor signify by saying aye.
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 Opposed? Motion carried. Next item we have is the Retirement Commission meeting minutes of February the 8th. What's your pleasure?
Move it with
Go-
the correction.
What's your correction, John?
On page 8, I'm sorry, February the 8th minutes, page 2, second paragraph. Action taken. I believe the date should be 2020 rather than 2021.
Okay, it's been moved with a correction. Is there support?
Golden
Carpenter
support.
support.
It's been supported. Any further discussion? Seeing no further discussion, all those in favor signify by saying aye.
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 Opposed? Motion carried. Next item we have is Retirement Commission special meeting minutes of February the 25th. What's your pleasure?
Seifert moves to approve.
Support. Carpenter.
It's been moved, it's been supported. Is there any discussion? Seeing no discussion, all those in favor signify by saying aye.
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 Opposed? Motion carried. Thank you. Moving on, we have no old business. Moving on to new business and coal. And I'll turn it over to Chris for us.
Good afternoon, everyone. And you want to share the screen or you want me to?
I think who has it right now? Star or Jennifer?
I do. I'm going to let him share. Let's see here. I have the PRISA up.
I'll start there, and then once we
Okay.
move past this, then maybe I'll take over. How's that?
Okay, sounds good.
So we were contacted by PRISA late last month about their intention to expand the size of PRISA 3. So if you recall, the retirement system has exposure to PRISA 1 and PRISA 3. PRISA 3 is the value add strategy, similar to the strategies that we looked at just a couple weeks ago when we interviewed those managers. So this is, a strategy that they're going out and buying buildings that need some sort of rehab and then, exiting them at some point down the road. They are looking to increase the size of their fund. So currently it's about 2.5 billion. They're looking at doubling that. And because of the increase in size, they're also looking at changing around some of the limitations that they had in the fund, which were really kind of based on this the 2.5 billion. So it'll allow them to do some larger properties as the fund grows and not be constrained to the dollar value that they had in there. We've reviewed this, we've talked with them about it, and we're all for having them, bringing in new investors and increasing the size of the fund. We did note that our expectation is this will take quite some time. So this is not one of those things where we think it'll be 5 billion by the end of the year. Our back of the envelope estimate might be like 5 years for them to get there, because they are, in the process of kind of rehabbing and selling properties, and they have to put those dollars to work as well as any new dollars that they bring in. So, so we think this is probably kind of a long-term goal of theirs. And part of it, we believe, is based strictly on the fact that real estate has appreciated since the last time the documents were restated. So they're just kind of updating them kind of with the times as market values for real estate have increased over the years. And I'd be happy to answer any questions there.
Anybody have any questions?
No.
So we need a motion then to approve the language change. Is that it, Chris?
Yes, and I believe, Frank, you've seen these documents, and I think what your thoughts were, it's really investment related, but I'll let you.
Yep, thanks, Chris. So yeah, our office reviewed these amendments as well. We don't have any issues with them from a legal standpoint. So yes, you would need a motion today to execute the amendment to PRISA Fund 3.
I was so moved to execute the amendment to PRISA Fund 3. Seifert.
Support Mandelaris.
All right, it's been moved and supported. Is there any discussion? I do have a question, Chris, in regards to basically what we have at this point in time. That's not going to change anything for us other than increasing what the ability is down the road, correct?
Correct. There's no change for Genesee County.
All right, is there any other discussion? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. Thank you. Chris, item B.
And hopefully the February market summary has popped up on everyone's screen. And if you're following along in the packet, this would be like slide 16 labeled C1B. And this is the markets in February. We had a pretty good month in February. Remember, January ended on a kind of a soft note, and we actually had some minor losses in the S&P. February, we made all of that back. You can see it was up just under 3%, bringing the year-to-date number up to about 1.7 for the S&P. Small caps continue to kind of be the favorite place in the market. You can see they're up another 6%, and year-to-date, they're up over 11.5. So we've seen kind of a real strong rebound in those smaller companies, as well as in value. Note that value, that Russell 1000 value index was up about 6%, and the growth index was flat for the month. So that's kind of a reversal of what we've seen over the last 5 years. If you look out at the 3 and the 5 year columns here, you'll note that the value index continues to trail by a significant amount. So it's just kind of a natural rotation we're seeing in the markets at this point, where investors are starting to realize that the growth companies can't grow forever, and that some of the value companies actually represent really good investments at their current valuations. And the same is true kind of on the small cap side. We did see interest rates continue to climb. So if you come down to that second group where it says fixed income, the US aggregate was down about 1.5%. That's 2 months in a row that we've seen some losses there as interest rates are climbing a little bit. And the other note here is we actually saw investment grade corporate bonds sell off a little bit there in February. You'll note that they were down 1.7, so they actually underperformed the index. And year to date, we're down 2 to 3% there in kind of core fixed income. So a little bit of a rough ride. And I think that's to be expected, given how low rates were we at the beginning of the year, and the expectation of some inflation creeping into the system, and then kind of the government programs that are being put in place and are going to have to be funded with additional bond issues, so that there's kind of more supply coming into the market, and to make them more attractive for investors, we're seeing interest rates creeping a little bit higher there. So any questions kind of about the markets in February? And so we've kind of continued to see a similar, the market's kind of continuing on this here into March as well. All right, I'm going to move ahead. I do have some updated market values for you. So you can see we're about 478 at this point, and it's a little bit higher than where we were last month, just based on some of the improvements in the equity markets. And note that on the fixed income side, we actually have seen a little bit of drop there in the SIT and Mackay portfolios, as you would expect with the higher interest rates and lower bond prices. You do see the PRISA 3. The second real estate investment manager down there. We have about $11 million, almost $12 million with that strategy, and a similar amount there in PRISA 1. That's the core fund. And I point that out just so that when we kind of talk a little bit about real estate here in a minute, you'll kind of be able to kind of put some names with the faces here on your manager summary. We have about $7.5 million currently in cash. We're expecting some money from WCM here in the very near future. Some of that will be put to work in the Mackay portfolio, but the bulk of it, about 8 million, will be put into the cash account to cover benefit payments here in the next couple months. Any questions there? All right. So then the last set of exhibits I have for you today kind of build off of our discussion that we had when we interviewed the real estate managers a couple of weeks ago. So some of the questions that were raised were, should we take a quick look at our asset allocation and see where we're at and what we might want to do there? How has the portfolio performed on the equity, fixed income, and real estate side? And just some general kind of questions about, where we've been and where we might want to go going down the road. So I put this together. I hope I kind of hit everyone's questions that were raised during the meeting. If not, I'm happy to kind of go back to the drawing board and come back with more information for you. And feel free to kind of jump in if you have questions along the way.
Chris, can I start out with a simple question? The monies that you were looking at for investing in a new real estate investment manager, those monies are already invested elsewhere. Is that correct?
They are. So if I flip back to the market value summary, you can see we're overweight in domestic equities by about 13 million. We're overweight in the international equities. That's why we're raising that $12 million from WCM. That will bring our international equity allocation down quite a bit. So that's where the money really is being held right now. That would, I would say, be earmarked towards the real estate portfolio.
Okay, I say that because I thought there was a concern, one of our trustees, that the monies were sitting idle someplace. That's not correct. They are earning interest. And even if we take another month or two or whatever it takes to decide on what directions we're going forward, that's my correction there.
Yes, that's accurate.
All right, proceed then. Go ahead.
So I did put up a quick snapshot of our asset allocation. And if you look at the little chart, one of Jeff Seifert's questions was, what are we allowed to do kind of under Act 314? So I put in our current targets as well as kind of the 314 max. And you'll note that domestic equities are capped at 70%. International, quite honestly, international is defined as anything international. So international bonds and bonds and stocks kind of fall into that category, is 20%. And then, on the fixed income side, we can go as high as you want. Real estate, you're maxed out at 20%. And then there really isn't any max on cash. The other note is that basket clause. So if you recall Act 314, and Frank, feel free to jump in if I misspeak on any of this, but the Act 314 has defined, global equities as it's written now, and then high yield and real estate. And so they've picked out some of the major asset classes and put restrictions on kind of the max weighting you can put into those. But then it also recognizes there's things out there that it does not define. And that's when I use the term basket clause. It's anything that isn't defined otherwise already in the act. So global equities, high yield, real estate, those are all defined. If you invest in something that isn't, then you can use this basket clause to put it into your portfolio. And a couple of the items that you can see are falling into that right now. We have the Bloomfield funds, and then a couple of the old hedge fund pieces that are, very, very small at this point. We're literally talking less than $1 million there, but technically we still keep track of those. So those are the investments that we currently have in the basket clause that aren't defined elsewhere within that Act 314. And you can see we have lots of room there. If we wanted to add something else in that alternative space, you have about 17% that's unaccounted for at this point. Any questions on that? So lots of room. The only one I would say we're kind of bumping up on is the international equity. I did go back from your 1231 report and pull out some historical performance for you. And you can see the total funds performances on that top line in bold, or yeah, top row in bold. And then we broke it out. I have the domestic equity, the international equity, and domestic fixed income. Unfortunately, we only have about 5 years of data. This came on board really when ANCO started doing the performance monitoring. So some of the historical data with George wasn't able to be brought over in that format. What I did though was include a benchmark that I would say is representative of that space. And so I put in the S&P 500, that MSCI ACWI, that's kind of all international stocks and includes the emerging markets, and then the Bloomberg Barclays US aggregate for your fixed income. So you can kind of see how that has performed. I will point out, over the last 5 years, having any small or mid cap in your portfolio actually kind of deterred from your performance. So when you're looking at your S&P 500 versus your domestic equity, one of the reasons that we're coming up a little bit short to that benchmark is because of our exposure to small and mid cap stocks. And then the other part of that is the low vol strategy not keeping pace with the S&P 500 over the last couple of years. So I do want to kind of draw your attention to real estate. The fund has done, I would say, very nicely in real estate. So if you look over the last 5 years, the real estate portfolio basically is your best performing segment. It's a very tight race between domestic equities, international equities, and real estate. They're all within a couple basis points at 11.5% roughly. And then I did include also on here PRISA 1 and 2 as kind of proxies for core and value add real estate. And you'll note that the PRISA 1 and 3, you can see that value add strategy with PRISA 3 has done quite a bit better over the long term than the core strategy in PRISA 1. So I'm going to pause there, see if there's any questions.
I have a question. When you look at domestic equity up there, really because we have 70% of our domestic equity money is tied up with WAM, which is a low vol, low risk performer, using the S&P 500, isn't that stretching it a little bit? Shouldn't we be using something a lot lower for a comparison or a benchmark?
This is not a benchmark. I included the S&P 500 strictly as a proxy for domestic equities. And it kind of ties in with when we look at some of the exhibits coming down in the next couple pages. So I just wanted to put up, what we've seen kind of from the U.S. equity market really was kind of what I was trying to show here. Not necessarily, I don't want you to think this is a comparison of your fund versus the S&P 500. That is not a fair comparison. As I just wanted people to have an idea of what kind of real estate has done relative to domestic and international equities, if that makes sense. So this next slide is the historical performance for a whole bunch of asset classes. And then in the far right side, under those green columns, is our expected return and our expected standard deviation for those asset classes when we look out over like the next 10 years. And so if you come across like the US aggregate, that would be your core fixed income. Think of the SIT and the Mackay portfolios here. You can see the performance there is going to be very similar to the numbers we looked at just on the last page under fixed income. And then you can see the expected return for, the I would say midterm future is about 2% with a standard deviation of about 3.4. So very low returns coming from core fixed income because of where rates are currently. And your core portfolios right now yield about 1.5%. So there's not a ton of yield coming in on those portfolios, and that's why that return expectation is set as low as it is. Then if you come down to kind of the US large, mid, and small cap, You can see the performance of those over the last, 10, 15, 20 years. And then kind of where we're looking at, they may go in the future over, say the next 10 years or so. And you'll see that like large caps, the expected return, and these are JP Morgan's return assumptions, is just over 5%. It gets a little bit better as you get into the small caps. It's up over 6.3 at that point. And you can see the the standard deviations are actually expected to be very similar to the historical, but the returns are much lower. And then we have kind of on the international side, you actually see that they're expecting the international markets to be kind of the better place to be relative to the US markets, but with more risk as well. So that's that EFA, the EAFE, and the emerging markets. And you can see, as I said, a little higher returns associated with those. But if you also look over the last 15 years, 20 years, they've drastically underperformed the US markets. And that's part of just a reversion people are expecting, that US markets have done so well, the international markets will have their time here. And we've seen a little bit of that so far this year. I did include private equity. As I said, that's one of the higher returning asset classes, particularly when we look at forecasted returns. You'll note that it's up over 9.3. Once again, the standard deviation there is going to be quite a bit higher. Private equity is going to introduce some other risk factors into the portfolio, notably illiquidity. So if you move into private equity, which would be in that basket clause, you would have very similar liquidity provisions to what we currently have with like the Alidate portfolios, the Cornerstone portfolio that Jeff referenced during his discussion. And then the last two I have on here, or not the two in bold, are core real estate and value add real estate. And you can see kind of the historical performance for them, and then the expected performance. And there are actually, I would say, two on the higher side here. So about 6.5 from the core real estate space, and then about 9.5 on the value add side. So once again, we're introducing that illiquidity when we move into real estate versus the traditional asset classes of stocks and bonds. And then the last one I included here is direct lending. This would be like the Bloomfields, where you're making loans, kind of private loans. You give up some liquidity, but you charge a premium on the yield side. And you can see about 7.5% kind of forecasted return for those. I will note that if you look at the standard deviation on that, it looks very low. That's partly due to that illiquidity with those types of investments. There isn't really a mark to market available there. So the expected standard deviation kind of tries to factor in some of that risk that you can't really account for when you're doing kind of appraised values for the asset class. And then on the very bottom, I actually have included kind of the Genesee County portfolio. So I've included your historical performance through year end, and then I've plugged in our target allocations that we were looking at on the pie chart page. And so when we plug those in, our expected return looking forward is about 5.7%, and you can see the standard deviation is 10.6. So I'm going to pause there, see if there's any questions.
Chris, I always have a question for you.
That's why I pause.
You're on this particular chart, you have your US small cap at 5 years. It's 8.23%. If I go to page C1B, your Russell 2000 index, which is small cap, 5 years is 17.6%. That's a big difference. That page right there. 17 was it 92?
Yeah.
Let's say 18%. 18% return is a lot different than what you have on that page at 8%.
Yeah, so I should have pointed this. These are updated through 12/31/2019. So it does not have last year included in there. And remember, last year was about a 20% year for small caps.
Well, really closer to 30%, but
Yeah, so we're shifting out probably one not so good year, and we are adding in a really good year on that 17% number.
so, so really, these numbers aren't that current then. I don't have much faith in them then.
I was saying, so the issue with that is some of the numbers aren't available yet. So like when we look at the private equity and the real estate, they're just becoming available. And so we update this once a year. Same, basically from private equity down, those numbers weren't available when I put this exhibit together for 12/31/2020.
Well, I wish we would have had the top 7 or 8 investments updated.
I'll note that. And I can do that.
Can you get that back to us at the next meeting then, Chris?
I sure can.
Or send us a separate email on it?
Yeah, exactly. That won't be hard at all. And I'll see if I can, I should be able to do the core real estate, maybe the value add. The private equity and the direct lending are the two that are the hardest in the group too.
Well, we really don't, well, the private lending, we do that, but the other one we don't do. So I'm not that worried about it.
Okay. And I wanted to include those because of the expected returns associated with those. So if we're looking at that 5.73 that we're kind of forecasting for the fund, you know, if you're trying to get that number higher, we're going to have to look at like the direct lending. We're going to have to look at the private equity and look at kind of shifting that direction as opposed to, you know, shifting into, you know, large cap stocks. That will actually take the number down more because it's only 5.13 versus the 5.73.
Well, I need to point out on your previous page for S&P 500, total return for 5 years is 18.8%, Chris. That's a good number. That's a great number.
That is.
What I'm saying, what I'm trying to say is I don't think our fund needs to get into the private equities, which we're not anyway, but I don't think we need to go there. I think we have enough investment tools right here that we can look at. I know that for some reason, a while back, the pension fund decided it wanted to go defensive and get into the WAM account, and where you have this low volatility, but also low potential yield. And we're never going to get 8% if we have over 120 million of our money is tied up there. We should also be looking at decreasing that amount and getting back into other equities, either large cap, which according to this one sheet I'm looking at that you provided, has done very well over, or even small cap. Both of them have done very well over the last 5 years.
They have. As I said, last year, they did phenomenal. You know, they, given kind of the circumstances of last year, to have 20% type returns for the entire calendar year, you know, very, very strong performance. And we'll have to kind of wait to see if that continues. As I think the forecasted numbers here are kind of expecting kind of that reversion to the mean. So if you think of kind of equities, and I'm lumping, you know, US, large, mid, small, international, I would say, you know, historically you've seen kind of a 9 to 11% type return from them when we look over 10, 20 type year spans. Given how well US equities have done in the last 10 years, I think the thought is they're probably poised to have some underperformance. And, you know, on here, the 10-year number is, you know, 13 and a half. I think it's quite a bit higher when we looked at, you know, if you look at that prior page that you you have in front of you. I can flip back real quick. You know, the last 5 years for the S&P, 16, almost 17. So I think that's where they're looking at saying, okay, the last 10 years you've done 17. Going forward, if we're going to get back towards that long-term average of say 10, we're going to have some years where we don't have quite as strong returns from the market.
But over the history of the markets, equities have always outperformed everything else over the long term. Not true they're going to have years or days when there's going to be corrections, but they've always done better.
You're right.
Last year we had a correction that lasted about a month.
Yeah.
And then within another 30 days, we were past the previous high and going forward. So, and it is a little bit more of a risk. So you have more of a deviation, but you also have more of a return. I'm just afraid that we're dooming our pension fund to have a yield of less than 8%. I don't know. I just get a little frustrated with not being able to sit in on some of these high numbers. And I remember once upon a time, this pension fund, when we were compared to other pension funds, other governmental pension funds, we always ranked in the top 15 to 25 percentile in performance. Now we're at the bottom, 70 and 80 percentile.
You're exactly right. And the bulk of that is that low vol strategy. That has been, I would say, the biggest detractor of the Genesee County employee retirement system's performance relative to your peers. That, you know, most of your peers have something that looks like the S&P 500 for their large cap. Now it could be, you know, they might have a large growth and a large value in a core manager, or you know, they might have it all indexed in an S&P 500 fund, or however they have that large cap allocation constructed. It has done quite a bit better than that low vol strategy that we're currently using with WAM. And I'd be happy to kind of revisit that low vol strategy. You know, we looked at that a couple years ago and looked at adding some different strategies to kind of balance out the low vol. I'd be happy to kind of bring those back around, and we can take a look at that large cap allocation and look to see if there's maybe a better fit going forward. Does that sound like something you would be interested in?
Well, I'd be interested, but I'm the only one that's speaking. I don't know what anybody else thinks, but if we're going to tie our money up, you know, 20% of our funds in an investment manager that isn't going to get more than 5% return, maybe 4%, then we're never going to get to our benchmark, our you know, the 7.5% we were trying to achieve. We're never going to get there.
Sure makes it hard. I do think, Chris, bring in some of that information for us, and we'll look at running into another investment committee meeting here. Also, this page 6 that you have on the screen, because if you can update those numbers as of the 2020 numbers as opposed to 2019 numbers, and then also I would ask you add 1 year column as in addition to precede the 5-year column, so we can see what those dramatic swings have been this past year in some of those categories.
Okay, I'm just making a couple notes here.
You know, another thing, Chris, the real estate reviews that we just did last month, that was for value added. And now that PRISA 3 is expanding, my question is going to be, they've already been a reliable investment company to be with. Why wouldn't we just allocate more money for them rather than new people?
That's definitely an option. I would offer that we need to be patient if that's the course that we end up going down. Where you would see, the managers that we spoke with over the last month, earlier this month. My guess is they'll probably get the money to work a little bit faster than if we went with the PRESA 3 route. But that's definitely an option. We could allocate a significant portion to them, looking down, because they do an exceptional job. And once the money's in, it gets to stay in, as opposed to where we're looking at the cornerstones and the Alidates and the GCERS, where once we give it to them, they end up giving it back to us, a couple years later, and kind of puts us in this position where we're at right now, where we've received quite a bit of money back, and then we don't have anyone taking any new money. And so when you get into the PRESA, you get to leave it there. And you don't have to worry about kind of always trying to find the next manager for the fund.
I guess I'd have to turn it back over to the chairperson to ask what are the thoughts of the other trustees? I hate to be the only one hogging the mic here.
Well, like I said last time, I was willing to divvy up half of the money that we're talking about last time to 2 investors. I don't want to push this farther down the road and say, okay, we want to go with preset 3. I mean, we already have money with them. I mean, we have like $22 million uncommitted in real estate. So to me, even if we do 10 million to the 2 companies we already looked at, that gets us our money back faster. And I know Mark was complaining. I mean, not complaining, but looking at, well, we have the money, we don't want to tie it up that long. You get it into 2 companies that seem to get it back faster, doesn't tie it up as long. That's my thoughts. I mean, I don't know how long Preset 3's had our money, so to tie it up to be another 5 years or 10 years down the road, I don't know if that's where we want to be.
Yeah, just as a point of clarification, I'm not looking at the tying it up aspect as being a concern. I don't mind tying the money up, since we have ways of making our expenses anyway, and that's not going to stop us from being able to meet our monthly expenses. But my concern is a twofold process. Is one, if there is a dip in the real estate market, the way it kind of looks like there's heading towards, from what I'm seeing, that I don't want to see a low yield back on that. And then the other piece of it, is that I also, when we allocate, let's say we allocate $10 million, but we don't end up getting the money called in, over that period, so that we only end up having, say, an average over 5 years, instead of having 10 million called in total the first year, we end up with an average by the end of the 5 years where we're actually getting a rate of return based on half of that allocation, just because of the fact that the money hasn't been called. Whereas when I look at what the Standard & Poor 500 index has done here, that I think there's ways for us, if you look at the 1 year, 3 year, 5 year averages here, 18% for 1 year, 14% at 3, and 15% at 5 year averages. I think we might be a little bit farther ahead to kind of reverse our direction a little bit, and instead of investing, into this real estate side, to go into the some of the U.S. equity, and also, as Jeff has pointed out, the great amount that we have in the low volatility with WAM, that we might want to look at reallocating some of that also.
I'm all for getting out of the low vol. So you're not gonna discourage me on the low vol. I mean, but like I said, I just think if we put two in the real estate, if we divide it up into two, you're gonna get more people to call it than if you just put it into one company and just wait around for them to give it a call. But I mean, that's just my opinion. I know when I came on board, we were already in the low ball, so I don't know if that's the take of everybody else on the board's appetite for investments and how risky they want to be.
Right. I think on some of that stuff, I think maybe what we want to do is get that information from Chris. Let's plan on having another investment committee meeting here in a couple weeks, and or a week or so after Chris can get us that information, and then let's kind of sit there. If we can do it in 1 hour, great. If it takes us 4 hours to do it, let's come up with a strategy of what we want to do at that point in time, if everybody's willing to do that.
Go ahead,
Jeff.
Carpenter.
I was gonna say I would just rather take a motion now to at least get at least 10 million of that uncommitted money moving. So I mean, we've done a lot with this real estate. It seems month after month after month. So
Now, when you refer to uncommitted, that's kind of incorrect, I believe, from what Chris is saying. Chris is saying that the 20 million is invested elsewhere. Is just going to take it from other people and move, in your instance, 10 million into real estate. Is that correct, Chris?
I think we're maybe not using the terms exactly the same. So the uncommitted that Jeff Carpenter is referencing, I put that page back up, and that he's looking at the uncommitted capital and looking and saying there's about 23 million that we're supposed to have in real estate, but we don't currently. And that's based on that 8%, or excuse me, 18% target that we have for real estate for the fund. Jeff Seifert, I think, is saying it's not uninvested. It may not be committed to real estate, but it's invested somewhere else in the portfolio. So from that standpoint, as I said, that you're both right, I think, is technically what I'm trying to say. if that's okay. It is invested, and we technically are, $23 million uncommitted in real estate. So,
and if we took it out, we'd probably want to reduce it out of either the U.S. equity or the global equity, correct?
So we would, we make a commitment, and I think, as Mark has pointed out, just because you make a commitment, we make a $10 million commitment doesn't mean, come April 1st, $10 million is going from our domestic equity portfolio into our real estate portfolio. It just means over the next 2 or 3 years, some money close to $10 million probably will be shifted that direction. And we would take a look at this sheet as part of our liquidity program, that we kind of try to factor in those capital calls and say, okay, what do we expect these managers to actually call in the way, in the next 6 months or so. And we try to have that money kind of available in the cash account, as well as to cover the benefit payments. So it would continue to be invested in, international equities, domestic equities, could be fixed income. I will also point, as we look at this page, Alidate 3, Alidate 4, JCR 3, we are expecting money back from those here in the, the coming year or two. And I think we just received something on JCR that distributions pending on that. I mean, they are actively, selling properties in those portfolios, and when they do, our allocation will continue to go down. And I did make a note. I'll contact Precinct 3 just to see what they're looking at. If we were to make a commitment to them, say we wanted to increase our allocation by $5 million, when do they think, that might actually happen? So that at least we can use that as part of our reference when we're looking at the real estate portfolio.
Okay, through the chair to Chris, looking at that page, your international equities, we're already over the 20 percentile. We have 22.6%. So we should be looking at reducing.
We just took $12 million out, Jeff.
Oh, we did?
Yes.
I'm sorry, I missed that.
So that actually occurred at the end of the month. And I think when we put these market values together that first week in March, the money hadn't showed up yet. So it's still listed in the WCM column, but I believe it's actually showed up in the cash account at this point.
Okay, looking at what Jeff Carpenter is referring to, I'm not opposed to then taking 10 million and using that into one of the new, or if Jeff wants to split them, I guess that's his choice, for real estate managers. But I definitely want us to address our equity situation and this low volatility and where we want to be going in the near future, because we're not going to ever get to that 7.5% achievement. Anyway.
Yeah, I do want to point out, so last year was a horrible year for the low vol strategy relative to the S&P 500. I would tell you, historically bad. That generally speaking, if you were to ask me how is the low vol strategy going to perform, I would tell you it probably captures 70% of the upside, and probably the hope is maybe only 50% of the downside of the S&P 500. And if you put that together over a 5-year span, maybe you come up short of the S&P 500 by a little bit over a full 5 years or longer. The issue we ran into last year was that when the market sold off really strong towards the end of February and into March, it did not protect us at all. And part of the reason was that some of the safer parts of the market that you would have thought would have, that historically hold up in those environments did not. And some of the more volatile areas in the markets, like technology, that don't find their way into that low vol strategy, those were the areas that actually held up. The Apples and the Amazons survived better than anything else, and yet we didn't have really any exposure to them. And then when the market rebounded, it was led by those same names that have, the technology, the Facebooks, and once again, we didn't have any exposure to them. And so we captured, 100% of the downside, and then we only captured trying to think, about a third of the upside. So we got back to where we started the year at, but everyone else was 20% ahead. And that's because we went down 20 with everyone. And then when the park came back up, well, it took us the full year to get back to where everyone else was by the end of June. So as I said, it was just one of those, I would tell you, kind of weird years. So I don't want you to think the low vol strategy is never going to, it's stuck at 4% or something like that. That's not necessarily the case. I still think it makes sense for us to take a look at it. So I'm all for looking at some other strategies within that large cap space. But I don't want everyone just to walk away from this meeting thinking the low vol is the worst strategy ever created. And it just had a really bad year in the way it, 2020 was a kind of a fluky year in the markets. Generally speaking, when you get a sell-off, the technology names sell off the hardest. We didn't get that last year. So And so I definitely have that as a note, though, that we'll revisit the large cap strategy.
Chris, going forward, I have concerns about other kinds of viruses hitting our global, becoming a global issue again. I don't think this is the one and done. I think we're going to see more of this kind of things. And that worries me about these kinds of investments. Anyway, you're going to have to do a better job at selling this to me anyway.
Okay.
And when you come back for our investment meeting, I want you to have those graphs to show over the last 40 years how equities did, how bonds did, how real estate did. I know you have them in your library.
Yes.
Because these are the graphs I'd like our trustees to see on where the money's coming from for whatever.
Sounds good to me. As I said, I like looking at the long-term numbers as opposed to shorter periods.
Well, I respect that, but I think in today's world, we only need to go out about 10 years or so, because if you go out too far, things change too quickly. Technology is changing rapidly, and the whole environment that we're in. Let's put it this way: 14 months ago, would we have known about this virus? Would we have had any idea that it was going to affect us like this? I say no to that. So I think going out too far handicaps us. In the trustees today and the trustees tomorrow for this pension fund, I believe they'll be smart enough to make those decisions to change investment tactics in order to capitalize on what's going on. Anyway, that's my thought.
Does anybody else have anything?
I was going to I have a couple slides here that I wanted to flip through. We looked at our expectations for those capital markets, for the different asset classes. I've put in 2 exhibits here from Horizon, and this is an actuarial firm that reaches out to a whole bunch of investment professionals to try seeing what their thoughts are. And all these graphs are showing is those are just guesses. So when you saw our expectation for large cap stocks at 5.5, that's in the ballpark of what other people are thinking, but you can see some people have them up over 8%, some of them have down around 3%, and I will point out they're all guesses. So I don't put a whole lot of weight in the expected returns that we just looked at. I will tell you, in fixed income, it is a challenge. If your portfolio only yields 1.5%, it's really hard to see how you're going to get like a 7.5% return there. So from that standpoint, I think you can put some weight on where we're at currently, but when you look at the equity markets, I would tell you it's really just a guess. And this is the 10 years, and then we have the 20-year numbers. They all shift upwards a little bit when they look out a little bit longer term. And I wasn't going to spend any other time on this unless there are any questions. And then my conclusions, and I think from the conversation we had, I think I have my marching orders, so I think we're all set there.
Share my screen. Can
All
everyone?
right. Go ahead.
Can you see my screen now? The retirees?
No.
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 Try it again.
And Jennifer, you want me to do it? I'll be happy to.
Yeah, this is what happened last time when I stopped sharing. I couldn't go back to sharing again.
Just give me a second.
That'd be great. It's on slide 28. Thanks, Chris.
Yeah. Let me, there.
We'll have to have an after-school practice.
Yeah. I can't even get into my email. My emails isn't working for some reason. I think there's a.
Does that look good?
Yeah.
Yep.
I can
Let me know if you want it bigger or anything like that.
Yeah, I can see it.
All right, you have before you item C2, schedule of reemployed retirees. What's your pleasure?
There was a correction, I did make the correction on the screen. There was a dollar sign under Mr. Wright. He did exceed his 1,000 hours and he was sent a letter.
Can I ask Jennifer a question? What happens next then, Jennifer?
Then he gets another month to go over and then he gets a second letter. So according to the policy, he can basically do it for 3 months before we stop his pension.
And you explain that to them in their letter?
Yes, it's explained in the letter that he's exceeded and he needs to come back within the 1,000 hours.
But do you explain to him that he could lose his pension after 3 times?
Well, I don't know that it refers to the 3 times. It's the form letter that was approved with the reso. I could go back and review that, but it does say that you're at risk of losing your pension.
Has Frank reviewed this letter?
I think the whole board did when they created the policy.
Okay, but I'm not an attorney, so I rely on Frank.
I think we looked at it back in 2017 when we adopted the policy, Jeff. So, so long as Jennifer's using the one that we approved with the policy, and I'm sure that she is, I think you're fine.
Okay.
I do recall we spent a lot of time on that. It went back to Frank's office on multiple occasions, making sure we didn't want to take away somebody's retirement that they had earned. But we do understand that they have to be compliant. So, all right. Are there any other questions on this?
Motion to accept the report.
Support Golden.
Been moved and supported to accept. Any other discussion? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. Next item we have is C3, schedule of billing and expenses. What's your pleasure?
Move to approve, Seifert.
Carpenter, support.
Been moved, it's been supported. Is there any discussion? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. Next item we have is item C4, schedule of deceased retirees. What's your pleasure?
Motion to accept, Seifert.
Support Mandelaars.
It's been moved, it's been supported. Is there any discussion? Seeing none, all those in favor signify by saying aye.
Aye.
Opposed? Motion carried. Next item we have is item 5, schedule of new retirees. What's your pleasure?
Motion to accept Golden.
Been
Carpenter,
moved.
support.
It's been supported. Is there any discussion? Seeing none, all those in favor signify by saying aye.
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 Opposed? Motion carried. Moving on to item 6, legal report, Van Overbeck, Mashad, Timney, and Judd. Frank, floor is yours.
Frank, thank you. I do see that Ms. Goldstone is on the call still, I believe. Laura, are you still there?
I am, thank you.
Sure thing. Yeah, so I'll turn it over to Laura from Labaton Cicero to talk about your security report, specifically the Is the Fix case.
Definitely. Since the last report last month, we've had 22 new security class actions that have been filed, but at this moment, you did not suffer any investment losses in any of those securities at issue. So that is not a concern, which is good, but we'll keep an eye on that. As to the Is the Fix case, I'm not sure where you are and what you remember. So back in December of 2019, Fortinbras opposed plaintiff's motion to distribute the funds. Luckily, the judge overruled the objection, but they did appeal. Just last month, the Second Circuit denied the objector's appeal. And so the settlement proceeds will soon be getting distributed. We're hopeful that we'll get that done in the next few months. There are a few motions that still need to be filed, and some minor additional expenses incurred from the claims administrator, but beyond that, everything should get settled up and we should be able to take that off of your agenda going forward. Have any questions?
Okay, thank you, Laura. Appreciate the update on is to fix. So that's 6A, and then you also have B and C, which are your reports from Robbins Geller. And they mirror the report from Labaton that while there have been new cases filed, none are really appropriate for you to file directly in. Oh, looks like Jennifer's sharing her screen now. Did we figure that out? Maybe. Either way, B and C can be for you to receive and file along with A. And then the only other update that I have on any items would be a legislative update on the Open Meetings Act. Our office is expecting Lansing to take some action here before the end of the month to end the amount of time where you're allowed to meet remotely for any reason. There's a couple different drafts floating around out there. One has the extension going through the end of June. One has it going through the end of the year. And the third doesn't really state a time frame. It's a different sort of draft proposed bill. I'm not sure which one is going to sort of win out in the end. But the problem is we don't expect Lansing to take any action till like literally March 29th, March 30th, somewhere in there. Hopefully I have an update for you before your April meeting as to whether that can be remote or not. But it'll be coming down to the wire. I mean, we won't know anything till, the very, very end of March here. But as soon as we know something, we will be prompt in sending out an update to you and all of our other clients. But that is all that I have today.
Frank, one question in regards, again, to the OMA. I believe, and you correct me if I'm wrong, do we have an ability for some members to attend remotely, like pre-pandemic? So if we do, would we have the ability for some members, not a majority, but some members potentially to, based on pre-pandemic standards, to attend remotely down the road, even if we do lose the ability to meet totally remote?
Right. So the only three reasons that someone would qualify would be if they're in active military, or if they have a physical issue where they can't be there, or if there's a local or state emergency declared either where they are or where the meeting's taking place. So I mean, it's not quite like it was before where we could call into the meeting or participate remotely for any reason. If this expires without an amendment, the trustees themselves would only have those three specific reasons where they could be in attendance remotely.
Okay.
Frank, this is Seifert. You mentioned the second reason of physical.
Yes.
Would 220 miles be a physical reason?
No, it's your physical condition, right? So it would be.
I tried.
Yeah, I mean, I think our office has taken the position of, if someone were to say I am high risk for COVID or I'm high risk for something else to be there in person, I think we would back you up saying, hey, this person has a high risk condition. They don't want to meet in person. They're allowed to meet remotely. The other item, I think, and maybe I missed it, active military duty. Did I say that one? Maybe I don't
Yes,
remember.
you did.
Okay.
Item 1.
Okay. So yeah, Jeff, I mean, if being out of town is not a good enough reason. If you're out of town and you're rehabilitating from knee surgery or something, sure, but just, you like it better up north? don't think it qualifies under the current language.
Hmm.
Thank you.
Right.
Of course.
Thank you. Do I have a motion to move to accept and file the legal report?
I'll make the motion, Mandelaris.
Support Golden.
It's been moved and it's been supported. Any discussion? Seeing none, all those in favor signify by saying aye.
Aye.
Opposed? Motion carried. Have nothing under informational items, nothing under other. Do any commissioners have anything else that they would like to bring before this body?
I would. This is Jeff Carpenter. I would really like to make a motion to invest $10 million into at least one, if not two, of those real estate agents that we've seen the last time. I think it was TerraCap and Chris, if you could help me with the other company.
Stanbridge.
Stockbridge.
Stanbridge, yeah.
Stockbridge.
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 See, actually, I didn't. Okay, I'll wait for the motion to go forward. So we have a motion. Is there support? Seeing no support, this dies for lack of a motion.
Through the chair, I'll support that just to get into discussion here on it.
Okay, it's been moved. It's been supported. Jeff, did you have some discussion?
No, I'm hoping that there's some other trustees on our board that will talk a little bit here.
I do. I just, again, it's not because I don't want to invest. It's just that I think we need to spend some time on restructuring what our allocations are across the board. Because again, we've seen some long-term gain, in the international equity, but we're maxed out. We're beyond maxed out there. So I just kind of think we need to look at trying to do a little bit of reallocation on it. I want to make sure that what our investments are on any of the real estate is we're paid on what the investment commitment is, so we're able to realize long-term gains, not just gains on half the money. The other thing is like here on the what I have in my notes here that I liked was the I did like Center Bridge, I did like Harbert, and I did like TerraCap. I did not think that Stockbridge was necessarily the best investment of the ones, or one of the best ones. And so, I think, I don't mind if we want to do some investment in TerraCap to look at that as we go forward too. But, we also saw today that there were several pieces of information that some of us wanted to get additional information from Chris on. I will call Chris in the next day or two, or at least before the end of this week, to give him some updates on some of the background information that I'd like to have on to do some comparisons for investments in the future. As Jeff Seifert did point out, it's not a matter that we don't have the money invested. The money is currently invested and that type of thing. So I don't know that, again, a couple more weeks trying to get more information is going to hurt us. And I do definitely understand what you're saying, Jeff, because I'm not one that kicks a can down the road. I'd rather let's deal with it. So, and I think my history shows that. This issue, I just want to make sure that with the changes in COVID and all of that we do a very good job on it. So, and again, I think we all have that same goal here.
Yeah, I mean, I'm just saying, real estate seems to be, I guess, almost one of the best spots that we invest our money at. So, I mean, I don't know, looking to put it in something else, is it going to be better than into real estate? I mean, real estate is probably one of our top performing venues that we have. I mean, out of all the other ones. So I'm sure where Chris can confirm if I'm right or wrong, but we're probably just putting this in probably in a equity account, which is getting us probably 4% versus a real estate account where we're going to get probably 8%. That's just the longer we take, it just seems like, and we have been just seems like month after month pushing this down the road. So, and I mean, I'm not even talking all the money that we have uncommitted. I'm just talking about half of it.
Yeah, I don't disagree with you on that stuff, Jeff. And again, it's not that, you know, all of this money is kind of committed at this point and it is invested. I do understand and agree with you on making sure that we look at investing this. If we can invest in something better, I'm in favor of that. But I also, you know, being the seat I'm sitting in is I'm seeing a little different processes going on here than what I'm used to seeing, and so that's the reason why I want to make sure that we do all of our homework on this before we go that direction. And you know, and again, I think Jeff asked for a lot of information today. You know, when we're looking at data that's from 2019 versus data from the end of 2020, there's a lot of difference when we're missing the last year of investments. Getting that data, that's skewing things also. So what I would ask is that we, I'm gonna, as I said, call Chris and try to go over with him some of what I want to see, which is maybe to say take this page from C2 and you know, take the page 8 of the investment strategy that showed the different recommendations to us, and you know, give us the same comparisons on there of, you know, 1 year, 3 year, 5 year type of strategies on all of them, so we can try to compare apples to apples. So anyway, I'm gonna quit kicking my dead horse here, so to speak. Is there anybody that has anything else that they'd like to bring up on these issues?
Well, here's an awareness. If we get money in real estate that's invested, and Jeff wants to take half it and put it into the Stockbridge repair cap, where's the money coming from? Couldn't we know that also? Maybe Chris could give us some direction at the next meeting.
Chris?
Yeah, so that page that we have the current market values, I think it was C1C.
C1C.
Yes, exactly. If you look at that page, that's kind of the page that we look at to address your cash needs. And so we put a liquidity schedule together roughly every 6 months that we try to forecast what we're going to spend, what we're going to receive, and into that factor, we try to estimate what the real estate managers are going to call in the way of capital. And so if you notice, your cash account is at about just over 7 million today. If you remember I want to say, you know, last year, I think we were in over 10, and that's because we kept getting money back from managers, and none of them were calling any capital. And so we kept having more money in cash, and we actually went, I want to say, like 9 months without raising any money. That's kind of how we got into the issue with WCM. They had an incredible year last year, and you know, we didn't need any cash, so we just kind of left the money with WCM. Once we hit the 20% mark, obviously, you know, we kind of earmarked them because we went over our 314 limit, and so that money is now being kind of reallocated to Mackay, and some of it will go into cash for benefits and potentially capital calls, but we're not really expecting much in the way of capital calls outside of potentially Bloomfield Capital 5. That's the one that I would tell you is still kind of actively calling money. But we'd use the exact same process, John, in that we would look at kind of what we forecast your cash needs, and then we would go to this sheet and say, well, where should we take the money from?
Right.
It might be WCM again. It might be Earnest. Those probably would be the two managers that are at the top of our list to raise funds from, to provide either benefit payments or to meet capital calls. And if you look at the add reduce column, all I'm doing is going to the ones with the biggest number in red. So that's the one that kind of gets picked on to kind of meet our current cash needs. They're the most overweight to our current target.
I see. Okay. Thank you.
All right, is there any other discussion? Seeing no other discussion, all those in favor of the motion signify by saying aye.
Aye.
Those opposed? Aye.
Aye.
No.
Aye.
So motion is, I'll say temporarily defeated, because I'm sure we'll be having this discussion again future, so in the near future. So, and I thank everybody for your time and discussion today. And at that, the meeting is now adjourned.
Okay.
Thank you.
Could I ask Jennifer to stay on the line for a second?
Sure.
Sure,
Jennifer, are you still there?
I'm here.
Thank you all.
Thank you.